You ever wonder how your email inbox just knows what's spam? Or how a bank decides if you're a good bet for a loan? Well, today we're going to pull back the curtain on how machines learn to sort our world into neat little categories. It's a process with some surprising power, and, as we'll see, some even more surprising limits.
So let's just jump right in with the million-dollar question, or maybe the trillion-dollar question. Can a machine actually predict the stock market?
Now, to even begin to tackle that, we've got to take a step back. See, we're not trying to predict a specific number, like a stock's exact price. No, we're trying to predict a label, a category. In this case, it's really simple. Is the market going to go up, or is it going to go down?
And this whole process has a name. It's called classification. Think of it this way. If you're trying to predict a number that can be anything on a scale, like the price of a house, that's something called regression. But if you're predicting which box something belongs in, like is this a picture of a cat or a dog, that's classification.
And the thing is, you're bumping into these classification models all day, every day. They're what decide if an email is junk, if a loan application looks risky, or even if a medical scan needs a second look from a doctor. They're kind of like the silent sorters of our digital lives.
So how do these sorters actually do their job? Well, data scientists have this whole toolbox of different methods or algorithms, and each one has a totally different strategy for drawing the lines between categories. Let's take a look at 4 of the big ones.
First up, we've got logistic regression. Now, don't picture a simple on-off light switch here. It's way more like a dimmer. Instead of just giving a hard yes or no, it gives you the probability of something happening. It smoothly slides from a 0% chance all the way up to a 100% chance, telling you just how likely it is that something belongs in a certain category. Next in the toolbox is linear discriminant analysis, or just LDA. Imagine you've got 2 groups of dots on a piece of paper. LDA is all about one thing, finding the single best straight line you can draw to separate those 2 groups. The catch? It kind of assumes that both groups have a similar spread, a similar shape. When that's true, it's super clean and really powerful. But what happens if a straight line just isn't going to cut it? Well, that's where Quadratic Discriminant Analysis, QDA, comes into play. Think of it as LDA's more flexible cousin. It doesn't have to assume the groups have the same shape, which means it can draw a curved boundary. This is awesome for more complex patterns, but all that extra flexibility comes at a price. It needs more data to work its magic without getting confused.
And finally, we have one of the most intuitive, easy-to-grasp methods out there, k-nearest neighbors, or KNN. The logic is so simple you could explain it to anyone. You are who you hang out with. To figure out a new data point, KNN just looks at its k closest neighbors on the chart and holds a little election. Whichever category wins the vote, well, that's the category the new point gets assigned to. It's wonderfully simple and doesn't make any assumptions about how the data should look.
Okay, so let's put it all together real quick. Logistic regression and LDA, they draw straight lines. QDA, it draws curves. And KNN is the most flexible of the bunch, basically letting the data itself draw the boundaries. So, which one is the best? Well, there's only one way to find out. Let's put them to the ultimate test. All right, we've got our tools, we've got our methods. It's time. Let's get back to that monster question. We are going to sick these algorithms on one of the toughest prediction problems on the planet, the stock market. So here's the setup. It's pretty straightforward, right? We took real historical stock market data and we gave our models a simple challenge. Just by looking at what happened over the last 5 trading days, can you predict if the market will go up or down tomorrow? That's it, a simple, clear-cut test. We fed all that data to our classifiers. We let them churn through it, learn all the patterns, the ups, the downs, everything. And the result they came back with? Well, let's just say it was a very, very humbling reality check. 52%. That's it. After all that sophisticated modeling, all those fancy algorithms, the best overall accuracy we could get was just 52%. And this just perfectly highlights the whole problem. I mean, sure, 52% sounds better than 50, but let's be real. It's barely, and I mean barely, an improvement over just flipping a coin. For all their complexity, our advanced algorithms were only a tiny bit better than pure random guessing. So what the heck happened, right? Why did our powerful models basically fall flat on their face? Well, it turns out this failure is actually way more useful than a success would have been. So let's break down the lessons we can learn from the machine's struggle. Okay, 3 huge lessons here. First off,
The stock market is just incredibly noisy. It's packed with random, day-to-day wiggles that are impossible to predict from the past. Second, even if there is a secret pattern hidden in there, it's probably not a simple straight line that our linear models could ever hope to find. But the third lesson? The third lesson is the big one. It's a classic rookie mistake in machine learning. We tested our model on the exact same data we used to train it. That's like giving a student the answer key before the final exam. Of course they'll get a great score, but it tells you absolutely nothing about what they've actually learned.
And really, this all boils down to one huge takeaway. There is no magic algorithm. There's no single tool that works for every single problem. The real skill is in understanding your data, its shape, its quirks, its structure, and then choosing the right tool for that specific job. You wouldn't use a hammer to turn a screw, right? Same idea. So that leaves us with this really big, kind of nagging question, doesn't it? If even our 52% result might be way too optimistic because of how we tested it, how can we ever really know if a model is any good? How do we build genuine trust that it's actually going to work in the real world? That, my friends, is a fundamental challenge. And it's exactly what we're going to dive into in our next explainer.